Stop me if you've heard this one before. A global superpower claims everything is fine. The president goes on TV on New Year's Eve, smiles at the camera, and promises 5% growth. The factories are humming, the ships are loaded, and the government says the plan is working. But then, you look at the receipt. It is January 5, 2026. While you were shaking off your New Year's hangover, a quiet data release just shattered the narrative of the global economic recovery. It wasn't a bomb, and it wasn't a bank run. It was a single number from a private survey in China. The Chinese consumer, the engine that companies like Apple, Tesla, and Starbucks have been banking on for growth, has effectively flatlined. The services sector, the one bright spot that was supposed to save the world's second-largest economy from a total meltdown, just hit its weakest expansion in 6 months. Why does this matter to a guy sitting in Chicago or a family in Manchester? Because we are staring at a terrifying economic paradox. China is churning out products that nobody inside China is buying. They are sitting on a $1 trillion trade surplus that is about to flood the global system, triggering a trade war that will make 2018 look like a playground fight. If you hold the S&P 500, if you own real estate, or if you're wondering why your grocery bill is still weirdly high while electronics are getting cheaper, you need to understand what just happened in Beijing. Today, we are peeling back the layers of the RatingDog leak, the Japan-Taiwan crisis, and the terrifying reality of the two Chinas. Let's get into it. Let's start with the smoking gun. In the financial world, we usually rely on official government data. But anyone who has been watching China for the last decade knows that official numbers often, let's say, smooth over the rough edges. That is why smart money on Wall Street pays attention to the private surveys, the ones the government doesn't directly control. Enter RatingDog. It's a private data aggregator that tracks the pulse of the Chinese economy on the ground. This morning, they dropped a bombshell. The China Services Purchasing Managers Index, PMI, slipped to 52 in December. Now, if you're not an economist, you might see 52 and think, hey, that's above 50, that means growth, right? Technically, yes. Anything above 50 is expansion. But in the world of high-growth emerging markets, a slide to 52, slowing for a fourth straight month, is the equivalent of a race car slowing from 200 miles per hour to 40 miles per hour on the highway. It's technically moving forward, but the engine is sputtering. This was the sector that was supposed to be bulletproof. For the last year, while China's real estate market was burning to the ground, the narrative was, don't worry, the Chinese people are still spending money on experiences. They're going to the movies, they're getting massages, they're traveling. That narrative just died. The data shows that new export business in the services sector has returned to contraction. That means foreigners aren't hiring Chinese consulting firms, they aren't using Chinese financial services, and most importantly, they aren't showing up as tourists. This is the canary in the coal mine. When the services sector rolls over, it means the domestic economy has lost its last leg of support. And when an economy the size of China's loses its footing, the shockwaves don't stop at the border. They cross the Pacific. So, why did the numbers drop? This isn't just about economics, it's about high-stakes poker in the East China Sea. According to Yao Yu, the founder of RatingDog, the primary culprit for this drop was a massive decline in tourists, specifically from Japan. Now, you might think, who cares if a few tourists from Tokyo stay home? You should care. Japan is one of China's largest trading partners and sources of foreign capital. But the relationship has hit absolute zero. We need to talk about Sanai Takaichi. She's the Japanese Prime Minister, and she is a hawk. For weeks, Tokyo and Beijing have been locked in a diplomatic standoff. Takaichi recently made comments regarding Taiwan that effectively crossed every red line Beijing has drawn. We don't know the exact phrasing she used, diplomatic cables are still analyzing the fallout, but the reaction was instant. Tensions spiked. And in Asia, when political tensions rise, economic flows freeze. Japanese tourists, who usually flood into Shanghai and Beijing spending millions on hospitality, luxury goods, and services, just stopped coming. This is critical because it highlights a massive vulnerability in the Chinese economy, reputation risk. For the last 20 years, China relied on the idea that no matter the politics, business would continue. The Golden Arches theory of conflict prevention, the idea that countries with McDonald's don't fight each other. That theory is dead in 2026. If a diplomatic spat with Japan can instantly contract China's service export business, what happens if tensions flare with the European Union? Or the United States? This Japanese tourism freeze is a microcosm of a much bigger problem called decoupling. It's no longer a buzzword, it's showing up in the data. Western and allied Asian nations are voting with their feet. For your portfolio, this is a massive red flag for any company banking on cross-border Asian travel or luxury goods. If you own stock in LVMH, Marriott, or even airlines with heavy Asian routes, this political standoff is directly eating into revenue. The reopening play of post-COVID Asia is officially over. We are now in the containment play. Here is where things get really weird and really dangerous for the US economy. While the services sector, the domestic economy, is dying, the factory sector just staged a surprise recovery. The official manufacturing PMI ended an 8-month contraction streak. Wait, what? How can factories be booming if nobody is buying anything? Welcome to the two China's paradox. Because domestic consumption is so weak, because the Chinese people are too worried about their jobs and their property values to spend money, the Chinese government has doubled down on the only trick they have left: manufacturing supply-side stimulus. They are pouring billions of subsidies into factories to keep people employed. They are making EVs, solar panels, batteries, and steel at a frantic pace. But since the Chinese consumer, the service sector data we just saw, isn't buying this stuff, it has to go somewhere. It has to go to you. China is currently running a trade surplus exceeding $1 trillion. That is a number so big it's hard to comprehend. It means they are exporting $1 trillion more in goods than they are importing. This is a deflationary bomb. To get rid of this excess inventory, Chinese companies have to slash prices. They are exporting deflation to the world. Now, you might say, great. I want cheaper TVs and cheaper EVs. Short term? Sure. Your Amazon cart might get cheaper in 2026. Long term? This is a disaster for Western corporations. If China floods the market with goods priced below cost just to keep their factories running, companies in Germany, South Korea, and the US cannot compete. We are talking about margin compression for the S&P 500 industrials. This explains the growing scrutiny from global trading partners mentioned in the report. The US and the EU are looking at this $1 trillion surplus and sharpening their knives. If you thought the tariffs in 2018 or 2024 were bad, get ready for 2026. We are looking at a scenario where Western governments might put up 100% or 200% tariffs to stop this flood. When tariffs go up, inflation comes back. So, here is the bind for the Federal Reserve and for your wallet. Scenario A, we let the cheap goods in. US companies lose profits, stocks fall, but inflation stays low. Scenario B, we block the goods. Prices skyrocket, inflation hits 5 to 6% again, and interest rates stay high forever. The weak service data in China guarantees that they must keep exporting. They have no internal demand to fall back on. We need to dig deeper into why the Chinese domestic market is failing. The report mentions that weak consumer spending at home continues to leave the Chinese economy vulnerable. Why aren't they spending? In the US, if the stock market goes up, people feel rich and buy a new car. That's the wealth effect. In China, 70% of household wealth is tied up in one thing: real estate. For decades, the apartment in Shenzhen or Beijing was the savings account. It never went down. Until now. The property sector has deteriorated further in late 2025. Prices are falling. Developers are still defaulting. Imagine if the value of your 401k dropped by 40% and you didn't know if it would ever recover. Would you go out for a fancy dinner? Would you take a trip to Disney? Would you hire a personal trainer? No. You would hunker down. You would save every penny. That is exactly what is happening. The services economy, which relies on discretionary income, is being strangled by the collapse of the property bubble. President Xi Jinping declared on New Year's Eve that they will meet their 5% growth target. But how are they measuring that? Likely through infrastructure spending and factory output. It's empty growth. It's building bridges to nowhere in factories for products nobody wants. The government is trying to fix this. The report notes that in September, they rolled out measures to extend museum hours, host sports events, and boost medical tourism. Let's be honest. That is like putting a band-aid on a gunshot wound. Extending the hours of a museum is not going to fix the fact that the average Chinese family has lost a massive chunk of their net worth in the housing crash. The retail sales and services grew 5.4% in the first 11 months of 2025, outpacing goods. That sounds good, until you realize that in previous years, that growth was double digits. The trend is slowing, not accelerating. The youth unemployment crisis plays a huge role here too. The report alludes to sluggish consumption. If the youth, the people who usually drive trends in services, tech, and travel, are lying flat, opting out of the rat race, because there are no high-paying jobs, the service economy cannot grow. Okay, let's bring this back to New York, London, and Toronto. How do you trade this? We have a situation where the world's manufacturing hub is desperate to sell, but its own people are broke. Risk number 1, the earnings Mississippi. Look at your portfolio. Do you own Apple? Nike? Starbucks? Tesla? Estee Lauder? These companies have priced in China growth for the last decade. They assume the Chinese middle class will keep rising. This data says, stop assuming that. If the services PMI is slipping, it means the Chinese consumer is retreating. Expect earnings misses from US multinationals heavily exposed to China revenue. Wall Street hasn't fully priced this in yet. They are still listening to the 5% growth official line. When the earnings reports drop in a few weeks, it could get ugly. Risk number 2, the currency war. Keep an eye on the yuan, CNY. With the domestic economy failing, China's easiest lever to pull is to devalue their currency to make their exports even cheaper. If the yuan drops significantly against the dollar, the US dollar index, DXY, will spike. A super strong dollar breaks things. It hurts US exports, it crashes emerging market debt, and it usually causes a correction in US stocks and crypto. Risk number 3, the inflation whipsaw. This is the trickiest one. In the short term, China exporting its desperation means lower prices for goods, good for inflation. But the political reaction, tariffs, means higher taxes on imports, bad for inflation. We are likely entering a period of high volatility. If China is pushing industrial output over services, look at who benefits from that. Commodity transporters, tankers, dry bulk, might see volume despite the weak demand, simply because China is stockpiling resources. Defense stocks, the tension with Japan isn't going away. PM Takaichi isn't backing down, and neither is she. Defense spending in Japan and the US is only going one way, up. It might be time to look at companies that are purely domestic to the US or Europe. Healthcare, utilities, local services. Companies that don't care if a guy in Shanghai buys a latte or not. The headline China services activity expands at weakest pace sounds boring. It sounds like something you scroll past on Bloomberg. But in January 2026, it is the most important signal in the market. It tells us that the pivot to a consumer economy has failed. It tells us that geopolitical tensions with Japan are causing real financial damage. It tells us that China has no choice but to flood the world with cheap goods to keep the lights on. The global economy is a connected ecosystem. When the second biggest lung stops breathing properly, the whole body struggles for oxygen. Wall Street is currently celebrating the soft landing in the US. They are ignoring the storm brewing in the East. Don't make the same mistake. Watch the currency markets. Watch the trade rhetoric from Washington and Tokyo. And take a hard look at how much of your portfolio depends on a Chinese consumer who just stopped spending. As always, the market transfers wealth from the impatient to the patient and from the blind to the informed. Thanks for watching. If you want to know which specific sectors I'm rotating into to hedge against this dragon-sized risk, check the link in the description. I'll see you in the next one.